we've covered many, many things today. And how about we sort of like just end up with a bit of a summary of what you'd suggest for a balanced investor, typical type of balanced investor, mum and dad investor. Where should they be putting their money at the present stage?
I mean, you're the advisor, but definitely my first point of call would be to work with a financial advisor that can appropriately determine what's best for their risk tolerance, but also their goals going forward. Depending upon their risk tolerance, I would say generally from a broad sense, overweight global equities for growth. Use Australia for your income, particularly given we are Australian investors, so we have our assets and our liabilities
like a metrics,
Aussie dollars, like a metrics, for example, or we have another manager called Coolabah in the fixed income space.
That's Chris Joyce.
Chris Joy, So he's a well-known columnist and political and economic commentator, but he's also the CIO and founder of one of Australia's, I think it is actually Australia's largest fixed income domestically.
Coolabah, is it?
Coolabah Capital
there
Investments,
you go.
yes. And so, again, investing is really not that hard. We can get caught up in the day-to-day noise, but if you'd ask me where markets are in 3 to 6 months, that's often more difficult to assess than where the markets will be in 3 to 6 years. And so with that in mind, building a well-diversified portfolio, thinking of the long run, having multiple exposures in the portfolio that do well at different times, so that's not entirely correlated and moving as one. Is really the best approach to take for the current market environment.
So what you're saying is that you can sort of like give up a little bit of a performance for diversification, which actually reduces the risk.
Correct. And that's a function of we're no longer in a world of zero interest rates. The cash rate here in Australia is 4.35%. And so expected returns are based off that risk-free rate. It's a lot more difficult to generate a 10% return from a diversified portfolio when interest rates are 0.5% than where it's 4.35%. So you don't need to reach and you don't need to take extra risk in order to generate those outcomes that clients are looking for, whatever that might be.
Well, that's a fantastic conversation. I really appreciate your time, Anthony. And we'll do this next year. What do you reckon?
My pleasure. Would love to.
Cheers.
Thank you.
Good on you.
No worries.